네. Hello, everyone. Today's session on international financial management. Today's session, we will be learning on Block 2, markets for foreign exchange and derivatives. This block introduces markets for foreign exchange and derivatives of international financial management. In this block, you have 3 units. That's Unit 4, 5, and 6. Unit 4 deals with foreign exchange market. Unit 5 covers market for currency futures. Unit 6, market for currency options. Unit 4, foreign exchange market. In this unit, you will be learning on meaning, distinction features of forex markets, the difference between forex market and stock markets, functions of forex markets, participants of forex markets, various types of transactions dealt in forex markets, and the financial instruments which are popular on forex markets, spot markets, forward markets, swap markets, etc. Foreign markets, exchange markets have become truly global in the sense that currency transactions now require only a single call and 24/7 the services are provided. As commercial banks have extended their businesses from the core banking services to this, they open up branches across globally. Banks have their branches namely extended in various foreign countries. They happen to involve and extend their services on foreign exchange market. However, the currencies and the extent of the participation of each currency in these markets totally depends upon the regular, local regulations. And these regulations differ from one country to another country. This particular unit will enable you to understand the meaning, structure, features, and major participants of spot and forward markets. Now let's get into understanding the meaning of foreign exchange market. Now, as we have been dealing on these subjects since last 2 classes, we have learned about what is foreign exchange, spot markets, future markets, etc. in line with the previous session. Again, foreign exchange market is nothing but where buyers and sellers are indulged in purchasing of foreign currencies. Okay, and when different countries, when a market where currencies are exchanged between one or more country, 2 or more countries, and are brought and sold, okay, that particular constant or exchange which happens between 2 or more countries, the currencies which are being exchanged, we term it to be foreign exchange market. The leading foreign exchange markets which are located are in New York, London, Paris, Amsterdam, and Zurich. In this global competitive financial market, the daily average, volume of the transactions are $5 trillion. And there are specific currencies which are quite popular. And among those are the USD, Euro, USD, Yen, Japan's, British Pound, Swiss currencies, and we have Australian currencies, Canadians, and New Zealand dollar also is are the few popular currencies. Now let's look at the features of forex markets. Now, coming to understand better the features, see, we have geographical spread. Now, these are not confined to the local markets or to the geographical limitations on the, country's boundaries. Within the boundaries of the country, they are spread across the global economy, countries. Hence, the foreign exchange market has no physical place transacting business. It is an, electronically linked network of the so-called big banks, and they deal with the function of buying and selling on these platforms. Another feature is differs from other markets. Yes, forex markets are not the same. They differ from the regular markets, like a foreign exchange market. When compared to other form of markets such as financial and commodity markets, they are not in same line. And in this exclusively, the foreign currencies are bought and sold. Unlike the other markets where commodities are exchanged, financial, aspects of other borrowing and lending, all these takes place. Whereas this particular foreign exchange markets concentrate only on buying and selling of currencies of, two or more countries. Then we have lower trading costs. Now, foreign exchange market. Now, last session, we've learned about the transaction cost involved in rendering the services by the banks, commercial banks. Yes. When a commercial bank is rendering a service like this, definitely some, transaction cost is involved, and also they expect a profit. Margin on the services which they are rendering. Hence, lowering trading cost is another best feature of foreign exchange market, wherein the cost is limited to the spread, that is the profit or the difference between buying and selling for a particular currency pair. And then we have 24 hours trading opportunity 5 days a week. Now, if you all have been, involved, if any one of you have been involved in foreign exchange, you will know how easy and convenient it has become to trade and use these kind of services which are available 24/7 and 365 days. Any transaction that you happen to involve happens to be within just a call away, and within 2 working days they immediately respond to your message, email, etc., thereby making it more convenient and getting attracted towards more and more customers on these markets. Trading in the foreign currency market starts every day on Monday at 8 a.m. That's Australian time, which is 5 p.m. on Sunday in New York time. It continues non-stop until Friday. Now, this works from Monday to Friday. Saturday and Sundays off. So Monday 8 p.m. it starts, and Friday 4 p.m. New York time it stops. Now, whatever increase and decrease in the market prices have been quoted, and based on those, the currency exchange of 2 or more countries, between 2 or more countries happens. Highly leveraged market. Now, this market is allowed to trade on margins, which is, generally borrowed money with foreign exchange. Hence, the participants here get more value, as a return, because it is magnified, and the currency rates keeps on increasing or decreasing. Hence, this happens. But however, one has to remember that there are always 2 sides of a coin. When it's increasing, it gets increased, but when it is decreasing, there may be losses as well. Next, we have excellent transparency. Yes, whatever and wherever the investments, buying and selling is happening, everything is made wide, online platforms, crystal clear to the participants. Here, the transparency is 100%. So hence, one can rely on and consistently do involve in these kind of markets. The this transparency is one of the best feature, we can say, because of which more and more people and participants are coming forward to get into such markets. Then we have access to the foreign exchange markets. It is not like we are in India and we are confined to only the markets of foreign exchange. You can use, or you can, if you are interested in any foreign exchange markets, yes, a participant can go without any geographical limitations towards any country with anywhere. It's just that one should have a proper internet connectivity and some basic knowledge on trading. If you possess these qualities, yes, you can go ahead and do get into such markets with other financial markets, and physically you can present to execute a trade. Next feature of these markets are liquid. They are most liquid market in the world. Now, currency spot trading is the most popular foreign exchange instrument around the world. See, immediately, whenever a participant wanted to liquidate means wanted to encash your, currency, immediately you can do it from your desktop. If you have connectivity, etc., you can execute your trade, and immediately your whatever you place as an order, it will get converted and it will be shown transparently in your account. So this being called as the most liquid market in the world, immediately spot tradings are available, because of which most popular foreign exchange instruments around the globe, not just confined to a particular geographical location, can be observed to be liquidated over any other market, whichever, wherever you want. Most dynamic market in the world. Now, this foreign exchange market is got dynamic, regarded to be the dynamic market in the world because of its, the various instruments that are involved in such markets, such as stocks, municipal bonds, US treasures, agricultural futures, foreign exchange, or any other countless, other instruments, which are all available to the participants. Hence, markets as an investment, the best investment opportunity remains the same for all the participants across the globe. And being a transparent, lower transaction cost, or other added benefits to the markets participants, wherein they happen to involve in trading. Then we have market transparencies. Price transparency is very high in the foreign exchange market, and the evolution of online foreign exchange trading continue to improve to the benefit of the traders. And this being a reputable foreign exchange broker will provide traders with streaming executable prices, exciting prices and executable prices. So here all the information on these lines about the prices, the broker, the agents available will provide all the necessary information to the participants. Next, we have international network of dealers. These markets have international network, because of which the major dealer institutions are particularly active and with the customers and with each other. Now, wherever they are located, these institutions are all linked up, with the telephones, computers, internet, and electronic means, because of which integration and international networks of dealers happen very smoothly. Next, we have most widely traded currency is the dollar. Now, we all know how the dollar, happens to perform in the market. The dollar is so far and by far the most widely traded currency. And according to the survey in the year 1998, the dollar was one of the two currencies involved in estimated 87% of global foreign exchange transactions. And this is, around $1.3 trillion a day. As against, this currency being the strongest and most popular and widely used trading currency. Next, we have the last feature as over-the-counter market with an exchange-traded segment. Now, what is over-the-counter market? Now, in the late 1970s, OTC, that is over-the-counter, by banks in different locations, making deals via telephone and telex. In the US, the OTC market was then and is now largely unregulated as a market. Buying and selling of foreign currency is considered as the, exercise the main function of an express banking power. Thus, commercial banking and security brokerage firms in US do not need any special authorization to trade or deal in foreign exchange. Now, over-the-counter market, with an exchange-traded segment, every bank in the US has got this, and every bank is able to do involve in the foreign exchange market without any special authorization. Unlike in many other countries, there needs a special authorization and clearance from their regulatory bodies. Okay, so with this, the features of foreign exchange are ending. So these are the special features of the foreign exchange markets, which are summed up in around 13 points. Moving on, we have how forex markets and stock markets differs. Okay, now let's see first point of distinction, that is meaning. What is forex market and what is stock market? Now, if you all know, stock market is a place where stock of publicly held companies are issued. Publicizedly held companies are issued, which are registered under in Companies Act 2013. Okay, now over-the-counter markets are also registered, whereas forex market is an international market where currency trading happens. And as we've already been discussing in the beginning, in this session in the beginning, it's a buying and selling platform of foreign currency between two or more countries, okay, based on the rates which are determined. Okay, so meaning here, forex markets means international markets where currency trading happens. Stock market is all about a place where stocks of companies which are publicly issued, they are, over the counter, they are being traded. Moving on, nature. Now, if you look at stock markets, these are involved in buying and selling of shares, whereas forex markets, currencies. Okay, forex markets are about exchange of currencies, trading of currencies, whereas stock markets is about exchange, trading of, buying and selling of shares of any company which are listed. Now, type of market, it is over the counter here in forex markets, whereas in stock markets, it is exchange traded contracts which are traded on the NSE, National Securities Exchange Board, and Bombay Stock Exchange. So only these are listed, whereas in forex markets, OTC, There is no centralized exchange for the Forex market. They're all decentralized. The counterparty risk, if you look at in these markets, Forex markets, counterparty risk exists here. Okay, there is no such risk in the stock market. Now, look at the number. In Forex, there are few currencies which are traded in the Forex market. Now, if you look at stocks, thousands of stocks are traded in stock markets, and thereby you can see in the newspapers and the various applications, the exchange rates, which it has got a huge data. Next, we have trading, that's buying and selling. Now, sell currency pairs even without buying them. Here in the Forex international market, you can sell even without even intending or intention to buy them. But here in stock markets, buy stocks in order to sell them. The basic, fundamental function of the stock market is involved in buying and selling of stocks. Quotations, if you look at, currencies are always quoted in pairs here, but here in stocks are always expressed in price. Okay, then accessibility, if you see, these are available 24 hours a day, 5 days. As we've already discussed, it is available from Monday 8 a.m. to New York timing, Friday 5 p.m. Whereas in stock, it is 8 hours a day, and again the same 5 days a week. Regulations, if you look at, there are few regulations as compared to stock markets, but stock markets are in comparison to Forex markets are regulated, and these are compared with Forex markets as well. Then we have spreads, that's profits or ask and bid. Yesterday's session, we've tried to understand about ask and bid, buying and selling. Spreads are the profits, the margin which is expected by the institutions which is performing these kind of services, trading services. So in Forex market, you see less spread, whereas in stock market, you see more spread. Spread means profit here. Speculations. Now, in the Forex markets, there is a lot, yet higher liquidity. Immediately you can liquidate, whereas speculation in the stock market is quite costly and very, less liquidity. Now, if you look at in terms of volume of trade, that's buying and selling, that happens around $5 trillion per day, it is recorded. Whereas in stock markets, it is around less volume of trade, roughly around $200 billion per day takes place. Liquidity, if you look, highly liquid Forex market is, and whereas stock markets is quite less liquid as compared to the Forex markets. Commission, yes, most Forex brokers charge no commission here. Instead, they make their margin on the spread. Trade here in stock market, traders must pay a commission to a broker. So whoever it is, they have to pay a commission here. Next, we have focus. There are 8 major currencies whose traders can focus on. Here, the currencies are being recognized. Okay, there are 7 to 8 major currencies which are listed here in Forex. Whereas in stock markets, there are thousands of stocks which are traded. Okay, so these are the various 15 points on which the Forex markets and stock markets have been differentiated. Now, once you're done with briefly, you can focus on writing in your own words about meaning, volume, trading, timing, liquidity, high, etc. Distinction between Forex markets and the stock market. Okay. Yes. Next, let's move on in understanding the functions of Forex market. What does it, perform? How does it perform? The various functions revolve around three, important functions, that is transfer function, credit, and hedging. Now, what is transfer function? Transfer function is all about to facilitate the conversion of one currency into another. Now, this transfer of purchasing power is definitely affected by a variety of instruments like bank draft, foreign bills, etc. Now, in these international clearing debts, both directions simultaneously, the domestic clearings will happen. The credit function. Here, credit function is, provides credit for foreign trade. That's bills of exchange, maturity period of 3 months, generally used for international payments. Credit is required for this period in order to enable the importer to take possession of goods and sell them and obtain money to pay off the bill. Next, we have hedging function. What is hedging function? A third function of the foreign exchange market. This is the third one, market, which in which a free exchange market, when exchange rate is in terms of currency, there may be a gain or a loss to the party. Now, in this condition, the person or the firm who's involved had a greater chances of risk. So there are huge amounts of net claims or net liabilities which are to be met in foreign money. Exchange risk as such should be avoided or reduced, but this facilitates for hedging anticipated or actual claims for liabilities through foreign contracts in exchange. So functions are summed up under transfer, credit, and hedging. Now let's move on to the next topic called major participants of foreign exchange markets. Now, what are the participants here who are involved in these trading of buying and selling at foreign forex markets? Banks and non-bank forex dealers. Commercial banks are the major players in the foreign exchange market. Commercial banks and non-bank forex dealers are the two participants. Among so many are the participants who are involved in trading of these trading here. Now, buying and selling of foreign currencies over their own accounts happens here. They earn a profit from buying foreign exchange, a bid the price and selling it at a higher price. Buy at low price and sell at a high price. Then we have individuals and firms. Individuals like any person, either it can be you or me, followed by organizations, institutions, companies, etc., who are involved. Excuse me. Individuals or firms. It can be anyone, which includes can be termed as exporters, importers, investors, tourists, students, or anyone. Firms which also operate internationally in dealing with foreign exchange markets. They have their own employees, their local currencies, etc. So anybody who is interested in these trading, they can get into, and they can start earning from their own countries. Then we have speculators and arbitrators. These two are another set of participants, a group of participants in foreign exchange market. Now, speculators and arbitrators buy and sell in anticipation of increase. They speculate that tomorrow or in a week or in a month, based upon several other internal and external factors which influence the prices. Based on those, they expect that the foreign exchange rate either increases or decreases. Based upon those understanding, these speculators and arbitrators happens to buy and sell in the foreign exchanges. So these exclusively these participants exclusively targets on making enough sufficient profits, and they deal in foreign exchange on their own and try to make profit through normal speculative deals. Now, they buy currencies from one country and sell them in the other country. They are exclusively into doing this kind of trading. They buy one currency from one country and they try to sell it in another country, anticipating some profits. So this arbitrage is thus a transaction of buying currency in one market and selling it in another market just to make the profits and price discrepancies. Next, we have participants in the form of central banks and treasuries. Now, these are again engaged in buying and selling of foreign currencies in order to adjust the rate of exchange between the foreign exchange market. Now, a government again deliberate to attempt to manipulate the rate of these exchanges through their intervention. Next, we have a participant in the form of exchange brokers. Now, these are the agents who charge commission for the function that they render. That is the services that they render. That's buying and selling. Because one is not possessing quite enough knowledge on trading. So hence we end up depending on these kind of exchange brokers for buying and selling. Hence they charge a nominal commission for the services that they are rendering. And then we have, they also act as intermediaries between the buyers and sellers. They are constant communication through various medias with large dealers, foreign exchange, and bring bids and offers together. Okay. Now, if you look at the position of the market participants in foreign exchange, it is presented here in the following diagram. At the bottom of the pyramid, they are all actual buyers and sellers. Then we have currencies and approach commercial banks to buy, then followed by brokers, and then on the top it is central banks who and the government which intervenes, intervenes in. Then we have, moving on to the next topic called types of forex transactions. Now, what types of forex transactions we have? Business transaction, hedging, arbitrage, and speculations. Now, let's look at business transactions. Now, what is business transaction? These are the transactions in foreign currencies which are carried out with a particular intention of either acquiring a foreign currency or selling off in the foreign market. So, some business transactions in foreign currencies are carried out by transnational service providers, borrowers, lenders, or investors. And next we have hedging. Hedging is, the exchange rates between currencies are constantly fluctuating. They increase or decrease. Now, under this floating exchange rate system presently, followed by most of the countries of the world. Now, parties who are committed to make payments in the future in some foreign currency would suffer a loss. And if these foreign currencies appreciates in meantime, on the contrary, they happen to expect and receive same foreign currency in the future, which would suffer a loss if the value of foreign currency, depreciates in the near future. Now, these parties are exposed to risk because of the fluctuations in the foreign exchange markets and would like to hedge their risk. Then we have arbitrage. Arbitrage is about, a foreign exchange market in a global platform with some important financial centers located on focusing only on a particular transactions, which are normally carried out by communication through communication channels. Yet a pair of currencies constitute a product in the foreign exchange market. However, it is traded globally in all important financial centers. The exchange rates for these pair of currencies slightly differs in two different centers. Now, these variations, if it is exceeding the transaction cost, the buying and selling of these currencies in two markets arises opportunity. This type of transactions is known as the arbitrage. And the person who is involved in engaging these transactions are known as arbitrageurs. Just now we learned arbitrageurs in the form of a participant. Now we have speculation. Speculation and speculator. The one who speculates is termed as speculator. Now here the fluctuations in the exchange rates of different currencies offer sufficient opportunities for those who are speculating gains. A speculator often buys some assets, anticipating increase in the prices in the near future, just to make their spreads. Their duty, their job is to speculate the market, anticipating the profits, making of profits by buying and selling of the assets in from one country to another country where they can make the best profits. Yes. So here we have four types of forex transaction. That is one, business transaction, hedging, arbitrage, and then followed by speculations. Next we have topic financial instruments. Forex markets and financial instruments. The various financial instruments which are dealt in the forex markets are spot contracts, forward contracts, future contracts, option contracts, and swap contracts. Spot contracts is where buyer and seller of different currencies settle their payments within 2 days of the deal. This rate is often prevailing. This rate prevails in exchange rate, and the market in which spot sales or purchases of the currency is facilitated, we call it as a spot market. What is forward market? It is all about future transaction where the buyer or seller enters into an agreement of making a sale or purchasing of a currency after 90 days of the deal at a fixed exchange rate. Now the exchange rate here is fixed. Unlike in spot, it is not fixed. Here it is fixed. This market is in which the sale and purchase of currency happens is called as on a future date. On a future date, when it is agreed for future rate, exchange rate, it is called as in forward market. Then we have future contracts. What is future contract? Any future transaction or forward transaction which deals with contracts in the same manner as that of normal forward transaction. Yet these future contracts differs from future forward contracts. These can be traded anywhere depending on the client's convenience. There is no margin, and the margins which are required are where all the participants' initial margin is kept as collateral so as to establish the future position. Next we have option contracts. What is option contract? Option gives an investor the right but not the obligation to exchange the currencies in one denomination to another denomination. This is agreed exchange rate on a predefined date. An option to buy the currency is called call option, while the option to sell is called a put option. Swap contracts. Swap contract involves a simultaneous borrowings and lending of two different currencies between two investors. Here, one investor borrows the currency and lends currency to the second investor. The swapping allows the investor to utilize the funds in currency held by them to pay off the obligation denominated in a different currency without suffering a foreign exchange rate. So swapping happens between borrowing and lending of two different currencies between two investors. Okay. So here The forex markets, financial instruments deals with spot markets, which is all about, payment which is settled within 2 days. Forward market is a forward contract wherein an agreement is been made for a future date on a future rate on which the transactions happens. Next we have within this generally happens for 90 days. Then we have future contracts. Future contracts is a forward transactions in this with the contracts in the same manner as normal forward contract. Okay, but it should possess some quality, some on some grounds it should be eligible, such as there should not be any margin. The contract will not have can be traded anywhere. It's all about the client's convenience. Again, this can be customized also. So on these lines, if happens, then we call it as to be a future contracts. Then we have option contracts. Option contract is all about call option and put option. Call option is about an option to buy the currency. Put option is to sell the currency. Swapping is swapping between two investors. Okay. Now let's move on to next topic, which is spot market. Now, what is spot market? Spot market is all about the timing of actual delivery of foreign exchange, which differentiates it from forward market transaction. In this market, the currencies are traded immediately, immediate delivery at a rate existing on the date of the transaction. Okay. And the features of this spot markets are, they are settled within 2 days. These are short date contracts, that is 2 days contract, and permits to deliver the currency even earlier also, before 2 days also. Now, debits and credit entries are made in the bank accounts of both the buyers and sellers. Most of the transactions are executed electronically in forex markets. Look at the demand and supply. This are the two components which determine the exchange rates. Now, spot markets are described by over-the-counter, over-the-counter, that is OTC markets, and there is no physical place where the participant needs to execute the deals. Wherever from you have your internet facility and you can execute the trading, then you can go ahead. Agreement is in the expressed in terms of the main currency. Calculations are all based on the secondary currency markets, which again is based on the main currency and the exchange rate prevailing on that day. Then we have currency arbitrages in spot markets. Arbitrage here is the process of simultaneous buying and selling of currency in two or more foreign exchange markets. Now, due to the developments in the information and the communication technology, these exchange rates are uniform. Okay, because of the various developments which are happening across, facilitates the uniform foreign exchange markets. Yes, consistencies exist in the foreign markets at a particular point. As a result, the arbitrageurs have an advantage of gaining profits. Now, if you look at types of arbitrages, we have two-point arbitrages, three-point arbitrages, which is also called as triangular arbitrage. Here, two-point arbitrage, please try to understand here, is the same currency pairs which are quoted differently in two different markets. Okay, same currency, €1 and €1. In London market, it has got a different price, whereas in Tokyo market, it has got a different price. So two-point arbitrage is all about currency pairs quoted differently in two different marketplaces. Whereas three-point or triangular arbitrage is all about three currencies and three markets which are involved. A triangular arbitrage opportunity occurs when exchange rate of currency does not match with the cross exchange. These prices differs generally because of the situations when a market is overvalued while another is undervalued. Okay, then we have a few simple problems on arbitrages. Like you can see, the following are the codes compute the codes, very simple problems in order to convert them, explain the arbitrages, explain how the arbitrages will gain. Then moving on, speculations in spot market. Speculation is a speculator who believes that the foreign currency will appreciate just to make the profits, and it is like a betting that a currency will appreciate, will grow. Yes. So with this, the spot market is done. Let's move on to the next topic called forward market. And here the forward market is all about a market which is between two parties requiring to deliver at some future date. And these foreign currencies are, again, as the payment is done. The forward contract is also called as forward exchange rate, and the market for forward transaction is called forward market. The important features of these markets are mostly the foreign exchange rate is determined by demand and supply. The demand and supply, if the demand forward exchange is more and the supply is less, then it is a premium, and vice versa. When the supply is more and the demand is less, it is discounted. Now, when the supply is equal and the demand is also equal, then it is to be at par. Now, here the settlement date plays a vital role on which the trade currency is delivered. Now, this is again fixed and already quoted in the agreements. The value date is in case of forward contract lies definitely beyond the value date applicable to spot. Broken date contract is a forward contract with maturity period of not a definitely a whole month. Then we have arbitrators in forward market who happens to the forward rate differences which happens in purchasing a foreign currency with a domestic currency. Investors here put up differences between the interest rates of two currencies. Now it is about a forward market already in the unit 2 in very detailed, it is already covered, so one can refer unit 2. Last session we have already covered. So forward market hedged is a mean through which it protects the exposure in foreign currency, interest rates, financial assets markets, etc. For example, here export billed in foreign currency creates a long position for the exporter. But if import billed in foreign currency, this will lead to short position of the importer. Then about speculation in these markets, we have speculator who believes to spot price at some future date will differ from today's forward price, and success here does not depend on the moment, rather the relevant position of the future spot rate. So current forward rate, the source of profit to the speculator is the difference between the forward rate and the future spot rate. It all depends upon the rate as on today and the future date. Then we have swapping of forward the meaning remains same, but the functions in terms of spot and forward slightly differs. The meaning of swapping all remains same. Okay, here the purpose of swap in the foreign markets is to earn profits, definitely. Option forward swap is there. Forward swap is available, wherein option forward swap means two exchange rates are mentioned. One is spot rate and the other one is forward rate. Forward swap is two future dates are chosen and profit emerges between these two forward rates. Whatever profits are considered during those two different periods are considered here. Then we have swap. Swap is a derivative contract wherein two parties exchange cash flows, liabilities from two different financial instruments. And most swaps involve cash flows based on notional principal amount, such as loan or bond. Each cash flow comprises one leg of the swap. One cash flow is generally fixed, while the other is variable. Swaps can be used to hedge risk of various kinds, which includes interest and currency risk. Now, types of swaps. There is around 7 types of currency swapping. That's currency swaps, interest rate swaps, commodity swaps, credit default swaps, debt equity swaps, total return swaps, and equity swaps. Look at currency swap. It's an agreement between two parties in exchange of principal loan amount and interest payment with principal and interest. Now, this is fixed or for floating currency swaps. Floating for floating currency swaps, authorized swaps, etc. Next type we have interest rate swaps. In this, some of them are fixed for floating, or and few are fixed for fixed swaps. Floating or fixed floating for floating swaps, option swaps, callable, puttable, expandable swaps, all comes under interest rate swaps. Then we have next commodity swap. Commodity swaps is wherein two sides of the deal agree to exchange cash flows, which are dependent on the price of underlying commodity. Commodity swap is usually used to hedge against the price of commodity. This consists of floating leg component and fixed leg component. Well, the fixed leg component is specified in the contract. Then we have CDS, credit default swaps. This consists of an agreement by one party to party to pay the lost principal and interest of a loan to the credit default swap buyer. Any excessive.
Ma'am, class is up to 12:30 only. We need break.
Okay. Yeah, we are ending. Another 2 minutes, we'll end up.
Okay, ma'am. Thank you.
Debt equity swaps are, this involves an exchange of debt for equity. In this case of publicly traded company, it is a way for companies to refinance their debt and relocate their capital structures. Next, we have the second last TRS, that is total return swaps, wherein the payer usually pays the total return, which is agreed on the security to the receiver and receives a fixed and floating rate payment in the exchange. Next, finally, we end up with equity swaps. In these contracts, the cash flows are based on a predetermined notional amount. However, these currency swaps, equity swaps do not mandate the exchange of principal amounts. The exchange of cash flows occurs only on fixed dates. So with this, the chapter on Forex markets ends up. Thank you.